Hello, and welcome to Investment Insight, your clear take on the markets. Let's get started. So, today we're diving into something kind of fundamental, almost a paradox, really. We all live in this, capitalist society. Investment drives so much, but most of us, we never really got taught the basics in school. Things like taxes, how debt actually works, really works, or even like the smart way to invest for the long haul. It's just missing.
It really is a huge gap in our education structurally. And the thing is, recent analysis suggests this gap. It's not just sitting there quietly. It's actually creating a lot of the chaos and volatility we're seeing in the 2025 market. You've got this massive wave of, let's call them amateur investors. It's like they're trying to merge onto a 6-lane highway full speed, but they never took a driving lesson, don't even know what the signs mean. So our mission today really is to unpack how this lack of knowledge is fueling the market craziness and, more importantly, give you a practical survival guide.
Okay, let's unpack this. Yeah, why is this gap so huge? Why did schools skip teaching us how to read, say, a simple balance sheet? Or why it matters to our own money when the Fed changes interest rates?
Well, the data seems to show it leaves loads of people in this really tricky spot of, well, not knowing what they don't know.
Mm-hmm.
They're missing those basic rules of the road, the core mechanics of how money and wealth actually work.
And nature abhors a vacuum, right? So
Yeah.
something fills that space.
Exactly. Since formal education drops the ball, people learn elsewhere. And where do they go? Platforms like YouTube, TikTok. Millions are getting their financial education there. The source material calls it spontaneous learning.
Spontaneous learning. It sounds quick, maybe, but for something like investing, that feels, inherently risky. 5-minute videos teaching finance.
Yeah, it creates a big distortion. Those solid long-term strategies, things like, value investing like Benjamin Graham taught, or just sensible asset allocation, they don't really grab eyeballs online. They don't get the clicks.
Right. The boring stuff, even if it works.
Exactly. So the algorithms, they push the sensational stuff. The short-term themes that get immediate reaction. So you see investors piling into the latest AI bubble or the newest meme stock or chasing some crypto spike.
Oh, okay. So they're chasing the sugar rush, the headline, instead of checking if the company actually makes sense financially.
Precisely. It's the total opposite of sound long-term investing.
I get the connection now. It's like if you don't know how your car's engine works, you just see a flashy sports car zoom past and you think, I want that, without knowing if it's safe or sustainable, or even if you can handle it. But is just telling people stop watching TikTok realistic? Maybe there's a way to blend the basics with how people actually consume information now.
That's a really important question. But even if we update how we teach, the core issue is still there. Foundational learning takes deliberate effort, right? Structure. Spontaneous learning, by its nature, is reactive. You're learning based on what's trending, what's loud, not on first principles.
Right, reacting to the noise instead of following a map.
Yeah.
And that illiteracy, it's not just about making a bad first investment, is it? It changes how people behave when things get choppy.
Absolutely. That vulnerability is key. Let's look at how this lack of basic knowledge really feeds the market madness we're seeing in 2025.
The huge AI rally we saw, that feels like a prime example.
Textbook case. Yeah. You have so many investors doing what the analysis calls blind chasing.
Just jumping in because everyone else is.
Pretty much, it's driven purely by FOMO, fear of missing out.
And the research shows they haven't really done their homework, have they?
No, not at all. People aren't buying these AI stocks because they've, carefully read the financial reports or because they understand the incredibly complex semiconductor supply chain. And they're certainly not buying because they've analyzed the valuation and decided it's reasonable. They're buying because they see it going up, they hear the hype, and they're terrified their neighbor's getting rich, and they aren't. It's chasing the shiny thing without checking under the hood.
And if you haven't learned the basic driving skills, you're completely unprepared for the hidden potholes or complex intersections on the market highway.
That's exactly it. And we've seen some really complex kind of hidden risks pop up lately, things that, frankly, an uneducated investor just cannot identify on their own. Think about things like the first brand's bankruptcy or the growing risks people are talking about on the private credit market.
Okay, wait, slow down a sec. For listeners who aren't familiar, what is private credit and why is it complicated?
Sure. So private credit is basically loans made directly to companies, but not by banks. It's by other lenders, often funding things like leveraged buyouts. The key difference is, unlike public bonds you might buy, these deals are opaque. They aren't traded publicly, they're hard to sell quickly, illiquid, and valuing them is, well, really complex.
Okay, so not straightforward.
Not at all.
Yeah.
Analysis shows that some amateur investors, they get drawn in by the promise of high returns, right?
Yeah.
But they end up exposed to these potentially serious, unseen risks because they just don't grasp the complicated structure they're buying into.
They see the high number, the return, but miss the complicated machinery and risk underneath. Got it.
Yeah.
So this lack of basic financial knowledge, like not knowing basic car mechanics, it also makes investors, well, emotionally fragile when the market hits a bump.
Oh, hugely. It drives massive volatility. There's a really striking example in the source material from last October. Research indicates that a tweet from President Trump threatening a 100% tariff, caused the entire crypto market to just plummet, drop 20%.
20%? Wow.
Yeah, liquidating something like $26 trillion in assets globally, just from one tweet.
I remember that feeling during that dip. Even if you think you know the fundamentals, it's hard not to feel that gut punch when the market swings wildly on like a single piece of news, especially unpredictable news.
Right. And that emotional fragility, it links directly to what some analysts call money trauma. Because many people haven't built up a healthy, rational, kind of rules-based relationship with money and investing, they lack, well, a shock absorber. If you haven't set up your own clear, rational investment rules, think of them as your mental seatbelts and airbags. Your gut reaction to a shock is pure emotion.
Panic.
Panic selling when things dip, or FOMO buying when things rally. And that behavior, ironically, increases the overall volatility for everyone. It turns small bumps into potential pileups.
So if everyone's driving without clear rules, one unexpected event like that tweet can send the whole highway system into chaos. Okay, so how do we fix this? How does the informed investor or someone who wants to become one survive this, let alone thrive in this emotional 2025 market?
Well, the survival guide, it really starts with acknowledging that paradox you mentioned earlier, that capitalism paradox. Step one is just accepting, okay, I wasn't taught this stuff in school. You have to be the one to consciously stop those knee-jerk spontaneous reactions driven by all the noise out there.
Okay, so own the gap, then actively decide to fill it yourself.
Yes, that mindset shift is crucial. You need to start treating YouTube, TikTok, Reddit, whatever, as just reference material, maybe idea generation, but they can't be your main textbook. To really earn that financial driver's license, you got to seek out the timeless stuff, the fundamental resources.
You mean like actually learning basic accounting,
Yeah.
understanding how interest rates really impact valuations, getting into those classic books. You mentioned Graham's The Intelligent Investor, Peter Lynch's One Up on Wall Street. That kind of curriculum.
Exactly that. That foundational knowledge is the only thing that actually lifts you out of just reacting to headlines. It gives you a framework, a lens to judge whether that finfluencer's hot tip is actually smart or just, reckless gambling. Without the basics, you're flying blind.
Okay, that makes sense. So insight 2 then is about mastering your own psychology, right? We talked about money trauma. You're saying we need to really look at our own gut reactions. Like, ask yourself, did I feel super anxious during that AI rally, scared I was missing out? Did I feel actual panic when the market dropped hard in October? Those feelings are clues.
They're absolutely data points. They show you where your emotional triggers are. And the key here, it sounds counterintuitive, but it's setting up an inverse rational principle to fight those raw emotions. This is where you need to be deliberately logical, not reactive. So when you feel that intense FOMO, that urgent feeling that everyone else is winning and you're being left behind,
Yeah.
that's the precise moment you should probably pause. Consider not buying or maybe even trimming if you already own it. And the flip side,
And when everyone's panicking.
exactly, when there's blood in the streets, widespread fear. That's often when a rational, long-term investor should be seriously thinking about buying quality assets at a discount. You have to consciously go against your gut instinct.
Okay, that's a tough discipline, but I see the logic. Here's where it gets really interesting, though, especially for beginners. The market feels like it's getting more complex every day, right? AI, quantum computing, weird financial products. Do we need to become experts in all this stuff?
Oh, absolutely not. No way. That complexity is actually a trap for most people. The single best defense against your own financial illiteracy, especially in a complex world, is embracing the circle of competence rule. It's simple, really.
Which means,
It just means do not invest in anything you don't clearly understand, full stop.
like Warren Buffett famously avoiding tech stocks for years and years because he said he didn't understand them, even when they were booming.
That's the perfect example. Knowing what you don't know and staying within your ability range, that's your best protection against those unseen risks like weird private credit structures or complex tech you can't explain. If you can't explain simply how the business makes money and why its stock price makes sense, you just don't invest. Period. Don't touch it.
Keep it simple.
Got it. So if we connect this to the bigger picture, what's the absolute simplest, safest play for that beginner driver on this chaotic 2025 highway? Someone just trying to get steady growth without crashing.
Yeah, the most powerful weapon you have against all this complexity and, frankly, potential scams is just simplicity. Keep it simple. The analysis really points to two core time-tested strategies that act like a financial autopilot. First, dollar cost averaging. Just regularly investing a set amount of money into reliable, long-term, broad market index ETFs. Think the S&P 500, maybe the NASDAQ 100.
So you're buying the whole haystack, not looking for the needle.
Exactly. You remove the stress of picking winners. You're basically betting on the overall U.S. economy over the long run, not one hyped-up stock.
Okay, that makes sense. And the second simple strategy.
Long-term investment in well-known blue-chip companies. We're talking about large, stable companies with long track records, solid financials, and crucially, companies that make products or offer services you actually understand and maybe even use every day.
Companies with strong bones, basically. Yeah, the structural integrity to weather storms. Sticking to these simple, understandable rules is really the surest path for most people to navigate this rather chaotic environment we're in.
So what does this all mean? It sounds like this financial education deficit isn't just some theory. We're seeing it play out right now in things like the AI frenzy, the crazy volatility from a single tweet. And the way through it, the survival guide, is basically stop reacting to the noise, build your own textbook of fundamental knowledge, get a handle on your own emotions using those counterintuitive rules, and then just stick to simple, understandable, long-term investments you actually get, your circle of competence.
That really sums it up. And here's something to maybe chew on. Given that so much of the spontaneous learning from finfluencers is all about chasing short-term wins, momentum, quick flips, how might this ongoing education gap actually change the length of future market cycles? Will booms and busts become faster, sharper compared to what we've seen historically? That's something worth thinking about.
Definitely food for thought. Don't forget to subscribe and hit that like button.